All right. All right. All right. All right. Yeah, man, it's Friday. I hope everyone is doing well. We made it to the weekend, and I hope you all are ready to enjoy a nice weekend. And so today in this session, I want to take a deeper look at what's going on with the economy and just share some thoughts with you guys and hopefully eventually get to an interactive session. I know that I do these things on the fly, so I don't schedule them in advance. I just kind of like when I get the time, I just hop on. But as I learn to use StreamYard, I'll probably will start scheduling things in the near future to give people an opportunity to set themselves up to join if they want to join. If you want to join and participate, as always, I appreciate the support that you guys give me by watching these videos. And so, with that being said, let's get into it. So, I'm going to share something that I just saw recently that I was looking at, and I thought this was like very, very interesting. And so it kind of plays into what I was saying earlier about where the money's going. And so here they're talking about money market funds. And so it looked like there was like a brief dip, but going back into money market funds is continuing to accelerate. Uh, it's like risk-free money, so to speak, right? So it's different than a treasury bond because every share in a money market fund is worth $1. And so the interest is paid on an annual. But again, this is better than what most banks are paying. And this is having a significant impact on the banks, right? As people shift away from using regular savings accounts because they can get higher yield from money market funds, more retail cash is leaving the banking sector. And I'm pretty sure institutions are taking advantage of it as well. Now, the interesting thing here, they're talking about retail investors have, piled into money market funds, right? And so they said about 2 billion in cash left prime money market funds, an indication that investors are starting to shift their allocations ahead of the Security and Exchange Commission's latest set of regulations, which are slated to take effect later this year. I still see this acceleration. I don't see this stopping. I think as more and more people wake up to the fact that they can get, a higher yield from money market funds, that they're not going to leave their money in traditional banks. And I think people are starting to wise up. For the younger generation, one of the smartest things you can do, and a lot of parents are doing this for their kids, is they're opening up, stock accounts at the institutions, whether they're creating custodial funds for their kids to save up money for their kids until they turn 18, or, they're pushing their kids to open up a stock account when they turn 18. But it's a different generation where now more and more you're going to see younger and younger people jumping into markets. All right. Now, moving on to treasuries, and this is the thing that I find very interesting, right? Is that, looking at what the Federal Reserve is doing with their treasury holdings, you can see that the holding of the Fed's treasury, the U.S. Treasury holdings of the Federal Reserve are continuing to fall, right? And so this is like draining money out of the economy, right? So I think they're letting securities mature. But this doesn't remove pressure away from the U.S. Treasury, right? So as bonds come to maturity and they have to be paid back, the United States have to continue to borrow at higher interest rates to pay this down. So it's still, $7 trillion is pretty high, right? But here, it says that, let's see, what does it say? Let's see, assets rise, okay, to 17 point, okay. Fed balance sheet. Okay, so 49 billion. Okay, was a drawdown. So yeah, they're continuing to let funds mature. Again, this is putting pressure on the government. And so the thing is that the government is continuing to spend, right? They're spending like crazy. So, and that's one of the things that I want to look at. And then it says on the side note, foreign central bank usage of the Fed's reverse repurchase agreement facility rose to the highest level in a year. So it looks like, there's a lot of activity going on in this space here. And then here, this is where, the cash for trash program is still hovering, at this level. It hasn't dropped from there. So it looks like what they're saying here is that the retail arbitrage, the banking arbitrage scheme that they were doing, where they were basically trading in low yield securities to get high yield securities and playing the spread to make money. It looks like that's coming to an end. And so that's going to put a lot of pressure on bank performance. So one of the things you got to understand, man, is like the banks are not really lending right now, right? So, you know, what I mean by lending, I mean by big lending, right? So, you know, that mortgage loans are like, you know, basically at an all-time low, home prices at an all-time high, cars are really expensive, dealerships are having trouble getting financing from banks, commercial real estate is in the can, you know, and so a lot of commercial real estate is overvalued, is due for refinancing at a lesser value. So, you know, a lot of banks are going to take haircuts on this stuff, right? And so that's going to put a lot of pressure on banks. It will be interesting to see in the coming quarters where the profits for banks are going to come from, because like I said, the consumer lending is not going anywhere. There's high credit card debt. They might get profit from that, but there's also high delinquencies there. And that's one of the things to watch, because I am seeing more chatter online about, you know, the delinquency and credit card debt. And so I think that's going to have an impact on bank balance sheets as well. So, you know, looking at how the government has to continue to spend, right? One of the things that I wanted to look at, and I'm going to show this to you guys, which is pretty interesting, is looking at treasuries, right? So what I want to do first is I want to look at this first one, right? Now, remember, in previous sessions, I've been telling you guys what you really have to look at is what's happening with foreign holdings of U.S. Treasury bonds, right? And so all of this is public information. You can go out there and look for yourself, right? And so here you can see, like back in 2022, you know, Japan had almost $1.3 trillion worth of U.S. Treasury bonds, right? And you can see, if you look over time, how this has kind of been declining, not by much, but just by a little. And what I notice is that, you know, countries that are with the West, you know, for the most part, their holdings are pretty steady. But what I want you to see here and really look at this is that if the United States is issuing all of this debt, right, where is it going, right? Because this is a slight decline, right? Now, if we look at China, mainland China had, you know, $1 trillion worth of treasuries in 2022. But as you can see over time, they've been letting their securities mature, and they've been collecting that money and putting it somewhere else. And so this is only till January 2023. And you can see the decline here. Looking at England was at 610 billion. Their holdings is just slightly a little bit higher, but not by much. You can see here with Belgium. Belgium is considered a big holder. They were at 243, so they went up, you know, and so they're almost up 100 billion, you know, from going from 243 to 331. But I don't know if that stays the same. But you can see Luxembourg pretty much stayed the same. So, you know, you look at Switzerland, they pretty much stayed the same. The interesting one is Cayman Islands. I'm like, gosh, I didn't realize that Cayman Islands has so much U.S. Treasury debt. But, you know, they started out at like 272 billion in January of 2022, and it's up to like 285 by the end of 2023, slight increase. But, you know, you got to think about the United States is spending trillions of dollars, right? They're borrowing trillions of dollars. And the question is where is it going? Canada, you can see in 2017, it went up to from 217 in 2022 to 254, right? Now what we're going to do is we're going to look fast forward to today, right? And so now we're going to take a closer look. So here we have in the end of 2023, Japan is still steady, right? They're still, you know, they're at 1 trillion here, they're at 1.1 trillion, not much change here. But if you look at China, right, China went from 869, now they're down to 767. Now, this is really, really important, because if you look on this list, they're like the number 2 foreign holder of U.S. treasuries, and they're selling off their holdings, and they're going to continue to sell them off, right? And the reason why is because I think China is preparing for conflict, right? And so they, you know, the U.S. let the cat out of the bag when they weaponized the U.S. dollar against Russia and froze Russia's U.S. Treasury holdings. That sent the message to everybody, right? And I've talked about this in previous videos before. You know, that was kind of the nail in the coffin for the dollar being a reserve currency, which allowed the United States to export its inflation to other countries, right? So the government would continue to borrow, and foreign countries would buy up, the debt because they needed somewhere to hold their dollars. But now that's getting ready to change because of the weaponization of the dollar and the weaponization of SWIFT, right? And so because these countries are trapped in the US dollar, they're subject to sanctions, right? And so they want to have more control over their economy. They want to have their own autonomy, and they want to have better control over their markets, right? So what this means is that these countries, if you can pay attention to what I'm showing you, they're not buying, but the US is still spending, right? And the question is, where is that money going? You know what I'm saying? It's got to go somewhere, right? The Fed is liquidating, right? They're getting out of the way. They're slowly. It's going to take them a minute, but they're letting their treasuries mature, and the U.S. is trying to figure out, okay, I got to rob Peter to pay Paul, so I'm gonna go ahead and borrow some more money and pay a higher interest rate here, and then I'm going to take the new money and I'm going to pay back the Fed, right? And so it's kind of crazy, man. But yeah, even if you look at the partners for the United States, right? In 2023, Great Britain had 705 billion in U.S. treasuries, right? But if you look today, it's 728. So they're providing a little bit of support, but it's not really enough to move the needle, right? Same thing here. When you look at Luxembourg, they're still in threes. There's a little bit of support there. Canada, they're at 359. They were at 245. So the Western countries are providing a little bit of support, but not by much, right? But if you notice, though, it's like if you look at like Cayman Islands, 288 to 302. France went from 184, they're up to 283. Yeah, and if you look at Brazil was at 224 and they're at 227. So they're on the fence, right? They're like, yeah, I'm gonna get out of the way. Saudi Arabia is an interesting one too. They're providing a little bit of support, but not by much, right? So the interesting thing, and I keep asking this question, I'm asking it repeatedly, and it's like, where is the money going, right? So this is where the money's going. So if you look at this, right, really take a look at this, and I'll see I can blow this up a little bit and how this impacts the screen. But yeah, if you look at this, right, here's the pension funds, right? Pension funds started out pretty low back in like the 1960s through the 1950s, the 60s, the 70s. It wasn't until the 80s where they really started taking off, right? And so here you can see you kind of had, a huge kind of like rally up here in treasury assets by pension funds. But ever since 2010, it's just kind of ballooned and took off. And then as we went to 2020, it's accelerated, right? And so this is where the money's going. It's pension funds, right? Pension funds, banks, investment funds, they're buying up treasuries. You can even do a search and say who are the largest U.S. holders of U.S. debt, and it'll tell you that. Now, the question you have to ask yourself, though, who are these pension funds? Because I bet most people who are working a job right now, your job is not paying you a pension, right? Well, let's take a look at that. All right. So the biggest pension fund in the world is Social Security, right? But Social Security, they're using a special security that I don't think they're using U.S. Treasuries. I've been trying to dig into this and stuff, and it says that the securities that they use in Social Security are only specific for that. So I don't think it's U.S. Treasury debt. But here you have the military retirement fund. Look at how much money, how much in assets, right, that they hold. It's not money. This is basically debt that they're holding, right? So you got to remember, one person's debt is another person's assets, right? So even though the U.S. Treasury is a liability, a debt on the government's balance sheet, it's an asset to the pension fund for the people in the military. So, this is what you have to kind of look at. It's a weird thing, man. One person's debt is another person's liability. And one person's debt is another person's asset. I'm sorry, I'm getting that confused. But the thing is that the military, has a huge holding of U.S. Treasury. And pension funds primarily invest in tier one assets, and tier one assets are U.S. Treasuries, right? If you go down the line, you got the federal employees retirement system. So, just after the military, you have the federal employees, the federal government, right? So people that are working for the government have a pension, right? And so the government, and it's kind of like funny if you really think about this, man. So the US government is selling all its debt, right? Countries don't really want it anymore. They realize they're writing on the wall, so they're selling, but they still got to spend, right? And so the pension funds are eating this stuff up, right? And so the question then becomes, it's like, where are they getting the money to invest in these funds and to invest in the treasuries, right? Are they pulling it out of the paychecks of these employees, these people that work for the government? And then where is the government getting the money to pay these people? Now, I'm being facetious here because I know the answer to all of this, but I'm saying this way because I really want you to think, right? A government job is paid with by debt, right? So when the Congress appropriates funds to fund the government, part of that budget is to fund all the people that work for the government, right? Now, when they pass this budget, they don't have the money, right? They have to go to the treasury market to issue bonds to raise the money to fund what they appropriated, right? So I'm hoping you following me here, right? Congress says I need $1.5 trillion to run the government, and run the government means to pay all these people that are working for the government, right? And then in order to fund it, they got to sell debt in order to fund it. And then the people that are working for the government, you know what I'm saying, are using the money that they get paid, or part of the money they get paid, to buy the debt, right? And so it's like to me like a huge Ponzi scheme, right? And so it's like, how long can they do this, right? And it's not just them. I mean, if you go down this list, it's pretty interesting, right? So you have a Federal Retirement Thrift Investment Board. So I don't know what this one's about. But here, look at California Public Employees Retirement System. You think they're buying U.S. Treasuries? And the list just goes on, right? So, here's another one, California State Teachers Retirement. You think they're buying U.S. Treasuries? Okay, you got New York State Common Retirement Fund, right? State employees. You think they're buying U.S. Treasury bonds, right? So, you got Ontario teachers. I think it says North America. That might be Canada, but, the list just goes on and on. There's Florida, there's Texas. I mean, when you look at this, Washington State, so you got, what else is in here? That's Wales. Let's see, state of Wisconsin, New York State Teachers Retirement System. I mean, it's a mega list, man. And they're holding like crazy numbers, man. Look at these numbers. It's like, I mean, this is trillions. This is like, 800 billion. 835 billion, right? So, if you really want to know what's going on, understand you got to follow the money, but you really need to think about this, right? Because the value of the dollar is also kind of tied to this, right? Because they're borrowing this money into existence. But a vast majority of this spending is kind of like a Ponzi scheme, a rob Peter to pay Paul, right? Because when the Congress passes their budget, right, and they go to fund it, they're passing that budget on the back of the U.S. taxpayer, right? That's us, right? They're saying we are going to pay for it, right? And then they do stuff like this, man, and then some of the stuff that they appropriate, giving money to foreign governments, right? If you think about that, they're sending that money over there to these countries, but those countries are sending that money back over here, right, to spend with corporations who then give money to Congress. They give board positions to Congress, right? High level management executive positions to members of who leave Congress, right? So, and there's like this revolving door where there's been people that worked in Congress, they didn't win re-election, and then they go and work in the private sector for a while, and then they run for office again to try and win, and so, that's a whole nother issue. But the thing is like looking at the money, right? And so thinking about this, it's like, where is all this going to go, right? And so they're continuing to have to endlessly borrow and spend and spend and spend. And so I think what they're realizing is that they need to bring more people into work. And I think what they're realizing is that they have to raise interest rates, right? Because there's a lot of people retiring. And, we have this huge retirement bubble in the United States right now. And a lot of these people who are going to be retiring are part of these pension funds, right? And so these people who are working and putting in their hours at these government institutions and for the military, they're promising, to pay them a certain wage when they retire. And so they need to be able to pay that money. And the only way that they can do that is if they have more people coming in, paying taxes and stuff, and, and funding this stuff. So, I wanted to show this to you guys so you can kind of see this for yourself, man. It's pretty fascinating to me, man, to see it happening. And I think that, you got to keep your ear to the ground on this. And it's like, what do you do, right? That's the question. What do you do? Well, one of the things we're seeing, they talk about Warren Buffett having a cash hoard, right? And so the thing is that we already know that the economy is kind of slowing down. The economy is in flux. We know there's major changes coming. There's, autonomy's getting ready probably in 2025 with vehicles. You have the robots coming in 2025, the first early stages. That's going to have an impact on labor markets. You have artificial intelligence now. So we have ChatGPT 4.0. So they're starting to mature in that space. And then eventually you're going to start seeing they'll call it productivity gains, right? But what it really is they're going to be replacing people. And so they're doing it slowly, but as they get their legs underneath them and understand the technology and they get the right resources working for them, they're going to accelerate, rolling out this technology. And eventually you're going to see more and more people get displaced, right? And so, you have that happening with corporations. And then on the flip side of that, in the manufacturing sector and in jobs that are repetitive labor, that's where you'll see robotics come into place. Robots have been here for a long time, but the humanoid robot is actually going to change the game because it's going to expand the capabilities, right? To where there'll be a vast gain in application of where you can use these robots, whether it's working a dangerous job, whether it's, working as a cook, whether it's, working in a warehouse, whether it's working on a manufacturing line, whether it's working at a butcher house, like at Tyson Foods. The applications are endless. They can even work on farms, right? So, if a farmer wants to hire robots to pick strawberries, they'll be able to do that, right? So the applications are endless. And then what's going to happen is that the implementation of the humanoid robot is going to drop the labor costs eventually down to like $1 an hour. And I know it sounds crazy, but that's what I'm hearing. And so it's like, it's funny because you hear people talking about they need, $20 an hour. We need to make more money. And that's, to me, that's the misdirection, right? They want you to kind of look that way and focus on, we're going to make more money, but you don't see the hammer that's coming behind you, right? And so that's what's getting ready to happen. So how do you prepare for that? Well, you definitely need to figure out how to leverage the financial system to make money. And that's something that I'll eventually get into. And getting into looking for opportunities in other asset classes, right? Like I said, gold, silver, Bitcoin. And speaking of that, I want to switch gears and talk about something that's a little bit different. Okay. If you pay attention to what's going on right now, you see the financial institutions are now putting themselves in position to create ETFs in order to financialize Bitcoin, right? And this is very reminiscent of what happened to the gold market. And so if you think back when way back with gold markets, before we had, paper contracts and all that stuff, you used to be able to go to an exchange and trade gold, right? And you exchange like the physical metal. If you fast forward to today, you have a futures market where you can buy and sell paper contracts and you never have to settle with the physical asset, right? You can settle for cash. So how does this relate to Bitcoin and ETFs, right? Well, if you really think about it, right, when they move to paper contracts where you can sell contracts for a commodity, and you have the ability to settle in cash where you never have to take delivery or have to deliver the physical asset, those future contracts allow you to control the price of the underlying asset. So I want you to think about that for a minute. You have a paper contract, right, that can be used to control the price of a physical asset. And you can settle those contracts without having to touch the physical asset. So how does this swing into Bitcoin, right? Well, first of all, the ETF is a financial vehicle, right? So when you buy into an ETF, you're not actually buying the physical commodity or the physical asset. You're buying a financial instrument that tracks the price in a certain denomination of that asset, right? So it might be 1/100th of the asset. It might be 1/10th of an asset. It's whatever the ETF wants to set. But when you put your money in that ETF, in your mind, you think that you're buying the underlying commodity. And what you really need to understand is that you're not. You're giving your money to a financial institution. And this is where it gets dangerous, right? Imagine this. BlackRock has an ETF for Bitcoin, right? Everybody knows BlackRock is a big name. Financial institutions are going to jump in. They're going to be putting millions of dollars in there and buying shares, right? But when you buy these shares, you don't have a claim on Bitcoin at all. Your contract is with BlackRock, right? And so what happens is they can settle your claim in cash and you'll never touch the physical asset. But your capital is now with that institution. And not only that, they're charging you a fee for it on top of it, right? So this is the fascinating thing out of all of this. Now, they can take that money, right, and they can go buy the physical commodity, which I'm pretty sure they'll do that. And once it gets big enough, right, what's to stop? The CME has already mentioned that they want to have a futures market for Bitcoin, right? And then what they're doing is using their reputation to say that, oh, we've been doing this for years for other things and we're the best and, we can do this right. And, that's the misdirection, right? It's another piece of the puzzle, right? Because I think the overall goal is to control the price of Bitcoin, right? So when they want to knock it down, they can knock it down. When they want it to rise, it can rise, right? And the way that they do that is through financialization, right? They'll use future contracts to control the price of Bitcoin. And so as people put their money into these ETFs, you're giving firepower to the financial institution to go out and buy the physical asset. And then once the CME is able to set up their futures contracts, you're going to have the CME competing with Coinbase, competing with Binance, competing with all these exchanges that had these future contracts for Bitcoin, right? And so it then becomes who has the most firepower, right? And if the CME says, well, you never have to settle for the physical asset, you can just do paper contracts, what do you think is going to happen? We already know, because if you look at what's happened to the gold markets for the last, 50 years, 100 years, look at what's happened ever since they confiscated gold and then we kind of got it back. The markets have been getting monkey hammered. It's the same thing in silver manipulation, so I think what's going to happen, and this is a little bit conspiracy theory here, but if past performance predicts future results, man, I mean, it seems like it's going in this direction. Once this stuff takes hold and it gets big enough, you're going to start seeing strange things happen with Bitcoin pricing, right? And so if they're buying up tons and tons and tons of Bitcoin with your money and charging you a fee, and then they're not obligated to work in your favor, right? And what I mean by that is that you could be investing in this commodity thinking that the price is going to go up, and then they're going to use your money to make the price go down, right? They're not obligated to create a profit for you. They're obligated of creating a financial instrument for you to take advantage of Bitcoin pricing without actually owning Bitcoin. And so you need to be very careful with these ETFs. You need to read the prospectus, so you can see for yourself that you don't own the underlying asset, right? And so knowing all of this, right, it's like, well, what do you do, right? Well, the first thing is don't ever put your money in the ETF, because you don't actually own the underlying asset. You need to own the physical commodity. So what you need to do is you need to go onto an exchange and you need to actually take your money and buy the physical asset. The beauty is that, places like Coinbase, you can actually buy Bitcoin, and it could be $10, it can be $20, it can be $50, it can be $60,000, right? You have the ability to buy the physical asset using US currency, right? Now, the second part of that is who has custody, and that's important, right? And so you can leave custody with Coinbase if you want to, but you have to understand that they're subject to US regulation, right? And so if at any time the government decides they want to confiscate what you have and it's sitting at Coinbase, it's gone, right? Because they're going to do whatever the US government tells them to do. Now, you can put your Bitcoin in a cold wallet, right? And so they have cards you can buy, and then you can set up your security parameters and you can pull your stuff off the exchange, and you can actually have physical custody, of your Bitcoin on your cold wallet, which is off the exchange, right? Now, Coinbase is going to charge you a fee to do that because they're going to try and deter you by charging you a fee to transfer your Bitcoin to a cold wallet. But I'm just telling you, man, if it's like you want to have possession of your assets, right? And so that's where you have the greatest safety. And so, in my personal opinion, if I was to buy Bitcoin from Coinbase, I wouldn't keep very much of it on the exchange. I might keep a little bit here and there if I'm going to be doing transactions with it. But if I'm buying it for long-term saving, I'm not going to keep it on the exchange, right? I'd rather have possession of it myself, and then the way the cold wallets work, if you need to use it, you can, right? And so that's something that I'll start talking about, some of the cards and stuff that you can get where you can hold Bitcoin. But this is something that I really, really, really wanted to highlight, man, is the dangers of these ETFs and the financialization of Bitcoin. They're basically using the same playbook that they did with gold and silver. And I think that, once the final pieces are in place, watch what happens with CME, that's when you're going to really start seeing fireworks and stuff. And so I would just be very, very careful, stay away from those ETFs, always go to the physical asset, same way you do with gold and silver if you want to have the best protection, and don't give the financial institutions the firepower to work against you, right? That's the thing. So, all right. So I covered a lot here, man. We talked about, where the money's going. And so we know that the government is borrowing, $1 trillion every, 100 days. And we know that looking at the holdings of foreign countries that the Western countries are providing very little support in buying U.S. treasuries. And, the global South is not really doing much. And in fact, China, which is the biggest global South holder of U.S. treasuries, are now down in the sevens. They used to have 1.2 trillion in U.S. treasuries, and now they're down to like 760 billion. So that's a big drop, man. And I think that's going to continue to drop. And I think once that's done, the second phase is you're going to probably see China liquidate U.S. investment. And so China owns a lot of U.S. real estate, a lot. Okay. When I say a lot. And it's not something that they can just liquidate overnight. But I think the U.S. Treasury part is the first part. And then the second part is they're going to try and insulate themselves from the U.S. putting sanctions on them by getting rid of their investments here. It's not saying they're going to get rid of all of their investments, but I'm pretty sure as they get closer and closer to settling up with Taiwan, that they want to make sure that they're in the right position. If it takes them 3 years to do it, 5 years to do it, they will be very meticulous and methodical about how they move. But the data is public information. So, you can look and see, as the change in treasury holdings diminishes, as far as foreign countries holding treasuries. And we see that domestically, it's the financial institutions and the pension funds that are, hoarding up all the U.S. treasuries. To me, it seems as if I would basically consider that as, monetizing debt, right? Because you're borrowing the money to fund the government, and then the money that you're borrowing to fund the government, you're using that money to buy the debt. Right. And it's just a circle jerk. Right. So they just wash, rinse, repeat every year, wash, rinse, repeat. And it's just funny, man, how the misdirection happens in Congress. Right. I mean, they say the silliest stuff, man, to distract you from what they're really doing. Right. Oh, we're spending too much on this pork here, pork there. Man, they're still borrowing money to fund the government, and they're using that money to buy the debt. Right. And it's like, how long can they continue to do that before it collapses on itself? That we shall see. And I don't think that it's that when I say collapse, I don't mean like, it collapses and the dollar goes away. It's just that what happens is, inflation continues to accelerate, right? I think the dollar will always be here. And that was, I had a conversation with one of my childhood friends, Chill Will. We were talking about this, about, will the dollar go away? Because everybody thinks, oh, well, the dollar collapsed, they'll replace it with something else. The dollar is just a currency, man. It's just a piece of paper that you use as a medium of exchange. So, in your mind, you can't think necessarily that it'll go away. I don't think the dollar will ever go away. The big question is what will you be able to buy with it, right? It's one thing, to need a fistful of dollars to buy a dozen eggs, but when you got to go to the store with a wheelbarrow full of dollars, that's a different story, right? So, that's what you got to really watch out for. And so I think it's more about, the value of the dollar going through a super crash to where it loses a tremendous amount of value. And then, that's when it's going to get crazy, man. And so that doesn't mean that the price of assets will go down, but they'll have to figure out something. But I think that, in terms of interest rates falling, like I showed you guys in the reports, man, it's not going to happen, right? They keep telling you, they keep selling you the dream and telling you, oh, it's, we're going to bring down rates. We're going to bring down rates. That's like the carrot in front of the horse, and you're pulling a heavy ass wagon with bricks in the back, right? They just keep you on that treadmill going with hope, thinking that, oh, the pain's going to go away. No, we're going back to real rates. And I'm pretty sure as the United States continues to borrow and borrow and borrow, that these rates are going to just bleed a little bit higher, a little bit higher, a little bit higher until something crashes. And then that's the only time they're going to drop rates, is when there's a huge crash in the market. And I just don't see that happening at this point. All right. So, all right. Well, I know I said a lot. And I shared a lot of information with you guys. So, for those that, didn't join me on the live, when you get a chance to view this, if you have questions or comments, go ahead and leave them and I'll try to respond to them. I do read them when I get a chance. And so with that being said, I hope you guys have a great weekend, and I will catch you guys on the next one. late